I want my money and I want it now. Our willpower, it doesn't last very long. I want my marshmallow and my cookie and my cake, and I want them all now. We're going to start off in a slightly different way. Welcome to another episode of WealthWise Banking. I am super excited to be here. We're gonna have some cruelty to children we're going to talk about first. And Jeremy, before I do that, before I talk about cruel experiments done on little kids, 4 and 5 year olds, and how that relates to your money, is there anything on your heart and mind, soul that you want to share?
No, I mean everything. A lot has been going on in my world and your world, and sometimes when things seem a little bit overwhelming, just stop and pause. And I've been very reflective and just so grateful that these are the opportunities that I have to solve in life because my problems are what most people pray to have, and so I'm very grateful to have the opportunities to solve these issues.
What a beautiful segment into torturing kids with mind experiments. So,
Hmm.
you know, maybe a little bit of drama right there, but what we're talking about is back in the 60s at Stanford, the Mischel marshmallow experiments. Jeremy, do you remember those? Have you heard about those before? Before I share?
Yeah,
Yeah?
if I'm
Okay.
not mistaken, the has to do with delayed gratification, right? The kids eating
Wait,
marshmallows.
man. This guy, he knows how to kill a punchline, doesn't he, folks? But hey, who's counting? Who's counting? This is like two truths and a lie. So, yes, Jeremy. Yes, you knew the answer. You're like me, man. You can't help but answer when a question comes, can you?
I mean, if you want me to just treat you like my wife asked me to do and sit and listen, I can do that, but I won't be participating much. It's just going to be all, it's mostly a one-way conversation with her.
Well, that is interesting. Someone needs to be seen, heard, and like Oprah said, what they say matters. But let's jump into Mitchell and the marshmallow experiment. So Mitchell had this devious plan, and he knew it was devious, right? He's gonna give these little 4 and 5 year olds a marshmallow, and he's gonna be in the room with them, and he's gonna tell them, "Hey, Jeremy, hey, Jill, I'm gonna give you this marshmallow. I'm gonna leave the room. I'm gonna wait 15 minutes, and if I come back and that marshmallow is still here, I'm going to give you a cookie or another reward, another treat. You're going to get twice the good stuff, twice the sugar rush." And so, as Jeremy said, what happened, the kids, the doc would leave the room, they'd film the kids, and what ensued was hilarity. The parents of all these children's 500 plus kids that were tested got to laugh and watch their children look at the marshmallows, talk to the marshmallows, have arguments with themselves, walk around, and they mostly lasted no longer than 3 minutes. 3 minutes. Would you guess? I thought it would have been longer myself. Jeremy, any thoughts on that?
I'm actually surprised you said 3 minutes as well. I thought it'd be a little bit longer.
Thought they'd
Well,
be
what was it?
longer, right?
What was the percentage of them that couldn't wait more than 3 minutes? Do you know?
I do. That's what we're getting to because I think it's very dynamic in our conversation some 50 to 60 years later here in 2025. It was less than 30%.
Wow.
Less than 30% were able to wait the whole time to receive the second treat. And it was fascinating, right? It's our human nature. Like it's funny, it's little kids. I mean, they're praying to the things or looking at them, they're talking to them, and they're popping those marshmallows, pretending they didn't disappear. Who knows what they're doing? It had to be wild, right? If you're one of the parents and you knew this devious little experiment, and you're probably thinking that is the funniest thing. But while I'm being light, while I'm being funny, it's actually really profound in my mind. It's really profound that it shows how difficult it is for us to delay gratification, and
Yeah.
how our willpower isn't, it doesn't last very long, right? Maybe 3 minutes for those, 70% of kids. 3 minutes, that's it.
You know what's funny is it kind of makes me think of this commercial too. I forget which company it was for, but it was I want my money and I want it now.
That's how we all want it. Yeah, the easy button at Staples, right? I want my money and I want it now. I want my marshmallow and my cookie and my cake, and I want them all now. But what they found, Jeremy, what was interesting is like you let the audience know, the more they hear it, though, the better. So it's really good that you already told them it's about delayed gratification. And the majority of people aren't able, I mean, you can develop this skill, this habit, this discipline, and there's experiments showing that, hey, it takes 66 days to create a new habit, which becomes that, that discipline, that willpower to create the new habit. And so, what we want to talk about today is how that profoundly has turned into something unexpected. Once people understood that people, the majority didn't delay gratifications, and the ones that in the experiment did, they went back and looked at how do they do in school, socially, in sports, whatever they were involved in. How did those 30% or less that were able to delay gratification and get the second reward, how did they do? And they found that they were wildly successful, more successful than the kids who weren't able to delay gratification at the beginning. And so when I saw that, I thought, and we were talking earlier today about what we were going to talk about and share today. And you're like, Jason, what's coming up a lot on your call? And I said, well, people are getting really confused. People are getting confused with all of these different ways to talk about the infinite banking concept and to implement it in their life. And they're so far past, a lot of them so far past where it would have been just easy to start from being young. The first time you earn a dollar, where do you store it? Right? And this is what we're going to talk about today is what it looks like, maybe not to delay gratification so much, but what it looks like to be intentional and proactive in your life. And instead of just popping that marshmallow in your mouth, how can you actually have your cake and eat it too, Jeremy? That's what we're going to tell people about. And we're going to talk about the power of paying yourself first.
Mm. All right. Yeah. So I think part of this comes down to is the real realization that people don't complain about life flying by too slowly. Like the idea of delayed gratification, it's not really a big rocket science sort of problem to solve because life, by and large, it goes by quickly. I've got a high school reunion coming up this year, 20 years, 20-year high school
What?
reunion. Yeah. And I was thinking about that. I was like, man, time is flying by quickly. But I look at where I am at today versus my peers, and I can tell you that a little bit of my delayed gratification has completely paid off for the benefit. So why is that important though? Why is that important that we talk about paying yourself first, delayed gratification, life flying by too slowly? How is that all playing today, Jason?
It's simple, Jeremy, and it's the thing that we share all the time. And I realized after teaching, after people read Nelson Nash's Becoming Your Own Bankrupt, they've watched videos in our webinars and our conversations with others who have practiced and used this and applied it and won with it. People are still confused. They still think that there's a way that they can do infinite banking without practicing the first law of wealth, without
Mm.
they think they can still do it. There's still some magical formula where they can take a HELOC, they can take a line of credit, they can find some money that they're going to find somewhere magically. And if they find that magical money and apply it to IBC, everything's going to be fixed. No longer will they have any problems. And I know, and you know, and everyone who practices or would hear that conversation would also know. The listeners know, you guys know, because you're here and you want to know what we know so you can know and apply.
Yeah. And just to get people caught up from episode 35, the first law of wealth is pay yourself first. Like that is the first law of wealth.
Mm, it is. And how much are we saying that they should pay themselves first, Jeremy?
A minimum of 10%.
A minimum of 10%. And then the second law, right? The second law of wealth is also to spend. You remember the second law, Jeremy?
Yeah, don't spend more than you make.
Don't spend more than you make. And for me, this one is the moat around your money. This one is you're creating a cushion, a margin. And so it's another 10%. So if you follow those first two laws, you're living off of 70 to 80% of what you make.
Hmm. And that's part of that. Is that part of delayed gratification or is that part of protecting yourself for the present and the future?
I think it is all of the above. I think it's living proactively. I think it's all of the above. I think it's living proactively because you understand that, Jeremy, Drum roll, please. There is one constant in life, and what is it?
Change.
Yes. Woo! Hear that, everybody? We got it. It's only taken us 8 months, 9 months together, but we have this figured out. So the one constant is change, and it could be an opportunity coming your way. It could be some kind of obstacle. But either way, if you're following the first two laws of wealth, you're delaying gratification by just not getting whatever marshmallows you want to put in your mouth today are, then you'll have more tomorrow and you'll be prepared for it. That's what we're talking about. That
Yeah.
makes
So how does delayed gratification fit into the world of infinite banking? Like why is this a constant theme in your recent calls?
Today I talked to a gentleman, great question. I talked to a gentleman who had some, he's a master mechanic, an awesome guy, awesome father, awesome, just a thinker. Like he's always reading and stuff. It really had to get to the point out of our conversation. Anyhow, point being, why? He had 34 debts, and the average interest rate on the 34 debts was 24.5% that he is giving away. And that volume of interest, and at least half of those were over 35%, which I didn't even know was legal. I didn't know you could do that.
Yeah, I thought the max was 30%. I thought it was usury laws and everything that actually kind of funny enough don't go more than 30%, but we it's not usury up to 29.9.
They don't round up for some reason with that number. I don't know what that's all about. But yes, that's exactly what we were looking at. And as we are diving in, how much was leaving on a monthly basis? It was going to take him, I want to say it was over 100 and some months to pay all of that debt off, and he would be keep paying interest to somebody else. And so he was like, Jason, I've watched Nelson Nash, I've watched you, I've read the book, I've done all these things, and we already had an hour conversation, Jeremy. And he's like, I don't know what to do. I've been since we talked a month ago, I've been paying myself 20%. I'm like, you know what to do, but I don't know what to do when it comes to banking. And that brings
Mhm.
us to what we're going to talk about in the next part. Why, once you start paying yourself, you need a place to store it.
Yeah. Yeah, I mean, just the idea you're talking about someone who's accumulated so much debt over time. My first thought process is how did you accumulate so much debt? Because you were over leveraged. You didn't pay yourself first, and you certainly didn't abide by law number one, right? Don't spend more than you make. If you're accumulating that much debt over time and going and paying Uncle Sam and paying, the credit cards and Fannie Mae and Freddie Mac, all these other folks before you pay yourself, you've over leveraged. That's what happened. It's a lifetime of over leveraging. And what did you say earlier? It was 60 something days to build a good habit. Just
Yeah,
spend first the next 60 days paying yourself first.
that's
Start
it.
there. Build a
That's
good
it.
habit.
That's it. If you're driving, write it down. Actually, if you're not driving, write it down. But write that down. If you're at the gym, stop, put it in your workout book. That you to establish this habit. Just start today. Start paying yourself 20 to 30%. I mean, 10 to 30% if you want, but I'm saying at least 20, and just start doing that and see what changes. Automate it, make it easy. And when he told me he was doing that and he was saving, even with all that debt, Jeremy, $1,600 a month with all of
Mhm.
that debt was new money that he was creating that wasn't earmarked for the debt and it wasn't earmarked for anything else. And so then he was just getting confused about where he should store it. And I started talking to him about, and you and I talked about this prior, about the power of uninterrupted compound interest, the power of protection, the power of guarantees, and being away from, frankly, from Uncle Sam.
Mhm.
And so
So,
where would he want to store this, Jeremy?
and your warehouse of wealth, one of Nelson Nash's other books. You just want to put it in a place that you have absolute control that, like you said, it gives you uninterrupted compounding. And that's kind of the best part about funneling your a portion. Again, we're not saying the entire amount. You still have bills to pay. We got it. The efficiency that has to happen does take time, and that's part of the pay yourself first, pay yourself with interest, delayed gratification. But
Mhm.
your future self is going to thank you for it 100%. And you got to start somewhere. So I recommend a properly structured whole life insurance policy from a mutual company that's been paying dividends for over 100 years. And that's a mouthful. If you don't know where to start, ask Jason, ask Jeremy.
Ask us where you can start. And So with his new identity that he was going to take back control, and I told you it was over 100 months. If he just kept doing what he was doing, he would have paid the other families interest from on an average of 25.5% per one of those debts, per 34 debts he had racked up, with a family, three cars, all the things, Jeremy. And I guess before I segue in, I just had a thought of Jeremy, was this man, this awesome guy, was he living proactively before or reactively?
Oh, it has to be 100% reactive. Because if you're racking up debt like that, you're probably an impulsive buyer. So you don't have self control. Getting back to the marshmallows,
He
right?
shoved the
You
marshmallow
don't
in his
have,
mouth. He didn't even make it to 3 minutes, did he?
no, no, he just took the entire bag to see what he could get. And that, guess what? When you're impulsive and you're eating a bunch of marshmallows like that, what does it lead to? A tummy ache.
And
And, and
yes,
he
it
created,
does. Yes,
yeah,
it
so
does.
he created financial pain in his life as well. He made himself sick. He was financially sick by doing that.
And he is sick and he's stressed and he's worried and now he just wants a solution. So I basically reached through the Zoom and shook his shoulders and said, "Come on, man." I said, "Snap out of it. You've been paying yourself first. Now, where are we going to store it? How much do you want to store in here?" We put a plan together that was 1,000 a month of the 1,600 he was saving. He said, "Well, my pay fluctuates. I am this. I'm commission based. I'm crushing it right now, but I don't know." I said, "Okay, well, let's make it safe, and we're going to make that floor manageable. So it's only going to be $310 of that 1,000." We didn't overfund it. Guess how many months by just implementing IBC and an actual strategic plan to pay off his debt, a debt snowball? 58 months.
58 months.
58 months. And what will he have at the end of that 58 months? This is what the people need to hear because he could pay it off faster. He could
Okay.
pay it off. He could pay it off faster. He could pay it off faster by just putting all of his money, all 1,600 a month, towards the debts, and he could technically get out of debt faster. But at the end of that time, what will he have?
Surprise me.
You know the answer. He will have no debt. He will
Well,
start
I
at
didn't think
zero.
the answer was that simple, but all right.
My name is Sipple, man. It's always going to be that simple. He will literally crawl out of the hole of debt like Johnny Debtor from below the zero line. He will climb back to that zero line, and he will be right back at the starting point for the rat race, as Robert Kiyosaki calls it. And then he's going to do what? He's going to start saving. And then when he needs something, he'll spend it. But if he did one thing differently, what would he have instead? He would have protection. He would have guarantees. He would pay off the debt, maybe a little slower, but now he would be paying all of that debt back to himself because if it's valuable enough for the bank to make 25.5% off his money, don't you think it's valuable for him to collect that 25.5% over the next 5 years?
It's funny you asked that because when you're mentioning before how much interest he was paying, I was thinking, I loan money to real estate developers, and if I came and started charging 20 something percent, they would turn and they'd run away. But the moment that they go grab that money from a credit card company or someone else, they don't have a problem paying it, right? It's just like, where do you find the value? And I guess my advertising, my brochures or whatever aren't as shiny in the mail. But I mean, if I could grab 20 something percent by loaning money, I'd do that all day long. It's just kind of absurd to me that they'd be willing to give someone else that. And like you said, being able to recapture that into their system in
Mm-hmm.
a system that has uninterrupted compounding and growing over time. You talk about 58 months, but it's not entirely delayed gratification because from day one that he put that plan in place, he now has guidance, he has direction, he has peace of mind. And think of
Yes.
the weight off of his chest, off of his family, to have a plan in place. Like, yes, it's going to take a while to pay off those debts. He also didn't get into that debt overnight. It's very like most habits, like getting out of shape, people who are out of shape, people who are out of shape financially as well. It takes time. And it's also going to take time to get back into financial shape. And now that he has a plan in place with guidance and direction, a good coach like you are, I'm sure that instantly lifted that financial weight off of him.
That is the yes, well said, and that's the hope, right? The hope is to give him a plan, to give him a simple plan. Hey, first, you pay yourself first. He followed that directive. He came back to me. He said, Jason, what's next? And I said, fill out the sheet. I need to see where you're at. And I didn't expect to see 34 debts, with that amount of money averaging 25.5%. I was kind of like, whoa, like this is a lot. Like this is maybe more, like this is showing, like you said, something had to happen for us to get there. But I thought he's reading everything I suggest. He's going out and doing more. And that's when I had to shake him. I'm like, hey, man, you don't need to learn anything more. You don't have to go read Money Master of the Game or go read, like Jeremy mentioned, Warehouse of Wealth or how privatized banking really works. He was talking about Carlos Lara and talking about Nelson and talking about David Stearns and talking about all these thought leaders. Napoleon Hill, all of them. Like I was like, I love this guy. I can talk to this guy all day, Jeremy, but stop it.
Hmm.
Pay
You know,
yourself
it's also
first.
in.
Pay yourself first. Apply for this, and then follow this payoff structure. And when you're halfway through, when you're feeling that change that Jeremy just asked, if you felt this man, we'll have him on here and we'll share the story with you guys so you can see it in real time.
You know what the beautiful part about this is? You're not saying that the secret is going out and earning more. Actually, the secret is capturing what you're already doing, just recapturing it for yourself and your family, and then allow infinite banking to do the compounding work for you. So, for a lot of folks that are out there chasing the dollar, in my opinion, as an investor, I'm going to tell you right now, it is much easier to save more of what you make than it is to go out and try to earn higher rates of return on what you have. So if he can get the same net effect of recapturing 24% into his own family bank, into his own policies, into his own warehouse of wealth, that's the same net effect of taking a dollar and trying to earn 24% or 28% or whatever it was. Think about that for a moment.
Yeah, think about that. If you still are confused about that, go back and listen to this episode again. And we didn't even talk about the family legacy, the protection piece that he's creating. He's already having his money growing, compound, and uninterrupted contractually, tax-free, and probably earning a dividend because the company hasn't missed a dividend payment in well over 100 years. And he's using the money to make 25.5% back to himself. You're like, yeah, but he took a loan. Okay, well, he's making a 19.5 point spread on the loan. He's paying off debt that would have taken him well over 100 months in 58 months. And he's got peace of mind for his kids, for his wife, and he has life insurance for the first time. And this guy is in his early 50s. So as we're wrapping this up, you know, maybe think about those little kids putting marshmallows in their mouth and think, how could I apply that Mitchell marshmallow experiment from the 60s and start just doing one thing differently and paying myself first, meaning that you're living off of 80% of the capital that you make, and that way, you start storing that money, store it somewhere that it's going to be safe, put it in a bank account for now. And then when you do this, then you need to be reaching out to us, having the conversation, or someone like us. Doesn't have to be us, but reach out to someone that can help you set up your infinite banking concept strategy of where to store the money. And that's going to lead us right into the next one, Jeremy. So, as all these fine people know, we're already in banking.
You're just not the banker yet.
See you guys in the next one. Be blessed. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.